The cryptocurrency market is a dynamic landscape that offers investors and traders many opportunities. However, it also poses some unique risks, including cybersecurity threats, regulatory developments, and market volatility. When there are more buy orders than sell orders, the price of a cryptocurrency goes up. Conversely, when there are more sell orders than buy orders, the price of a cryptocurrency goes down. 1. Know what you're investing. Cryptocurrency is a type of digital money that exists only electronically and is used to make transactions. People buy and hold it for many reasons, including to avoid transaction fees or because it offers some level of anonymity. It can also be a great investment, as its value can increase over time. However, it is important to understand what you're investing in before making any major decisions. This includes understanding how the cryptocurrency market works, as well as knowing what risks are involved in making investments. It is also important to keep up with industry news and be aware of any scams that may be floating around. Investing in crypto without doing your research is one of the most common mistakes that both new and experienced investors make. This can lead to being the victim of a pump and dump scheme, a fraudulent investment, or simply wasting your hard-earned cash. It's important to read reviews, investigate the team behind a coin, and check for any red flags that could indicate a scam. It's also a good idea to use reputable exchanges and always double-check your wallet addresses. Another mistake that new and experienced investors alike can make is letting their emotions get the best of them. The cryptocurrency market is a highly volatile place, and it's not uncommon for prices to fluctuate dramatically. It's important to remember that even the most established coins can see significant price drops, so it's vital to remain calm and stick to your investment strategy. It's also important to diversify your portfolio of cryptocurrencies. This can help to reduce your risk by lowering your exposure to volatile markets. You should also consider investing in stable coins, which maintain their value at a fixed price. Many beginners are drawn to crypto because of its rapid growth and popularity. However, it's crucial to remember that it is still a very young and emerging market, and there's a lot we don't know about its longer-term potential. While there are some coins that have a clear purpose and solid use cases, others are more speculative and are likely to be affected by market fluctuations. 2. Don't put all your eggs in one basket. The phrase, "don't put all your eggs in one basket," is a common proverb that warns against concentrating all of your efforts, resources, and time into one project. This is because doing so leaves you vulnerable to failure or loss if that project fails. Instead, it is better to spread your assets or investments across several different endeavors so that if one falls through, you won't lose everything. This principle is particularly important in the crypto market, as it can be difficult to navigate periods of declining prices without losing your investment. However, there are many ways that you can mitigate this risk and ensure that your cryptocurrency portfolio continues to grow during a crypto bull run. For example, you can diversify your investments by putting a percentage of your cryptocurrency into each of the major cryptocurrencies. This will help to cushion the impact of price fluctuations while also giving you exposure to new technologies and opportunities. Alternatively, you can also diversify within your crypto by investing in multiple smaller projects that have potential for long-term growth. In addition to diversifying your investments, you can reduce your risk by utilizing strategies like dollar-cost averaging or by hodling. Dollar-cost averaging allows you to buy more coins at lower prices and average them out over time, while hodling involves holding onto your existing holdings and potentially benefiting from their price appreciation in the long term. Lastly, it is important to remember that the crypto market is still relatively young and unregulated. As such, it is susceptible to cybersecurity threats and regulatory developments that could significantly affect its value. As such, it is essential to take precautions to protect your cryptocurrency investments, such as using secure wallets and two-factor authentication. It is also important to do your own research and avoid relying solely on the advice of others. After all, the people you follow on social media may have a vested interest in pushing certain coins or generating FUD, fear, uncertainty, and doubt, in order to manipulate the market in their favor. By taking the time to do your own research, you can make more informed decisions and avoid making costly mistakes. 3. Don't let fear drive your decisions. Cryptocurrency prices are volatile and can drop significantly. This is a risk that investors and traders need to be aware of and take into account when making decisions. In addition, the crypto market is often illiquid, making it difficult to buy or sell digital assets quickly. As a result, it's important to avoid making fear-driven decisions. Instead, focus on understanding the underlying factors that are driving your fears and make sure that any decisions you do make are based on fact and not fear. It's also a good idea to enlist the help of people who can provide you with an objective perspective. This could include trusted friends, therapists, or coaches. This can give you the support you need to look at your situation objectively and make a decision that is in line with your goals and priorities. The cryptocurrency market is complex and volatile, and it's important for investors and traders to stay informed about key trends and insights, as well as potential risks. Some of the key risks include cybersecurity threats, regulatory developments, market volatility, and liquidity risks. It's also important to understand how to manage these risks, such as by using secure wallets, two-factor authentication, and staying up to date on regulatory developments. Another risk is that the cryptocurrency market is prone to bubbles and crashes. This is a particular risk for new investors who might be lured into cryptocurrencies by the promise of huge gains. It's also important to remember that a crash isn't necessarily a bad thing and that prices can recover from even the most dramatic losses. Another potential risk is that the crypto market is rife with scams and fraud. It's important for new investors to do their research and be wary of influencers who might have a vested interest in pushing certain coins or promoting particular strategies. It's also important to be aware that many websites and social media accounts that post about cryptocurrencies are biased and may not offer an objective viewpoint. In some cases, these sources might be trying to manipulate the market by spreading FUD, fear, uncertainty, and doubt, or FOMO, fear of missing out. It's important to be cautious and do your own research before making any investment decisions. 4. Don't let your emotions get the better of you. The crypto market can be an exciting and lucrative investment opportunity, but it also presents a number of challenges. Investors and traders need to understand key trends, insights, and risks in order to make informed decisions. Some of the major issues include cybersecurity concerns, regulatory developments, market volatility, and decentralized finance. One of the most important things to remember is to not let your emotions get the better of you. It's easy to fall prey to FOMO and FUD when following cryptocurrency news, social media feeds, or chat rooms. This is especially true during a bear market, when a sudden downturn can leave you feeling scared or anxious. In these situations, it's important to remember that the best advice is always to do your own research and avoid taking advice from influencers or publishers who may have a vested interest in generating hype. Another thing to keep in mind is that it's important to have a clear plan in place for what you will do if the price of your crypto starts to drop. Many investors choose to use a strategy called hodling, which involves holding on to cryptocurrencies for long periods of time, even during market dips. This can be a good strategy for those who believe that a particular coin has strong long-term potential and are willing to weather short-term price fluctuations. In addition, hodling can also be a good option for those who want to minimize their tax liabilities in countries like the US, where holding cryptocurrencies for longer periods of time is more favorable than selling them in the short term.